Hi, I hope you all are doing really well. This is Ritika and we are doing reading 30th of corporate issuers called Cost of Capital. We are now on LOSD and this LOS requires us to calculate and interpret the cost of non-callable, non-convertible preferred stock. So before we begin, what are embedded options? An embedded option is a feature of a financial instrument that lets both or either the issuer or the holders take specified action at some future time. These embedded options are the provisions included in the fixed income security that allows the investors or the issuers to take specific action such as call back or redeem the issue early or convert the same into an equity, etc. Now, what are non-convertible, non-callable preferred stocks? These are the preferred stocks with no embedded options and should be stated at the dividend yield itself. And how are these treated? Now, since the preferred stock is non-tax deductible, it should not be adjusted for tax either. Say for example, suppose there are preferred stocks with a stated dividend of $5 and a market price of $80. The yield on such bond would be stated at 5 divided by 80, that is 6.25%. So what about the preferred stocks with embedded options? So if a new issue diverges in its term or has some embedded options with it, you should understand here that the options always add value to the bond. If these options do not have any positive value, then nobody would ever exercise the option. So they would be as good as non-existent. So for the time being, just take my words here that the options always have a positive value. And to calculate the value of bond with these embedded options, we need to make adjustments for the value of these options. That is, we add the value of option to the value of the bond. If the new preferred stock has the options embedded in form of conversion rights in the hand of holders, it would lower the cost of capital. However, if there are options in the hand of the company, such as to call the shares for buyback, then it would raise the cost of capital. And these two only from the point of view of the company. Now let's do a question. Morgan Insurance Limited issued a fixed rate perpetual preferred stock 3 years ago and it placed it privately with institutional investors. The stock was issued at $25 per share with $1.75 dividend. If the company were to issue preferred stock today, the yield would be 6.5%. The stock's current value is A. $25, B. $26.92 or C. $37.31. For the current value, the dividend of $1.75 is 6.5% of the current value of the bond. So the current value would be 1.75 divided by 6.5%. That is $26.92. So option B is correct. That's it with LOSD. Practice more problems on the same and find the study material on ProCFA.com. If you have any problems, contact us. We'll get back to you with a solution.